hello everyone. Welcome to the presentation of our full year results for 2021 and giving you a little bit of direction of how 2022 has started as well. So thanks very much for your time. Our aim today is to skip through these slides, use them as a guide rather than sort of walk through in detail and then take any questions at the end. So hopefully we'll be through the slides in 20 minutes and give us lots of time to kind of really understand what's on your mind and give us some questions if you have them. So my name's Chris. I've got Claire with me, the CFO. We kind of calculated between us, we've got about 36 years in the business, and we'll kind of work out how that splits. But a lot of depth and kind of commitment from us, not only sort of from today, but also from the past as well. So we'd kind of like to walk you through the business a little bit to start with, and then talk about the Pebble Group, its space in the market. So the Pebble Group is the provider of digital commerce and products and related services into that global promotional products industry. If I take you onto the left-hand side, just really want to sort of focus on it's a $50 billion market globally. So, it's kind of quite niche in that sort of marketing, advertising space, but $50 billion is kind of, the size. So I think a lot bigger than a lot of people think. And also a really fragmented market. And so we try to find some really specialist and differentiated spaces in that market. And half the market's in North America. And in North America, there's around about 20,000 businesses looking to provide promotional products into businesses in North America. And our first business, Facilisgroup, provides digital commerce into those 20,000 businesses, looking to help them bring efficiencies, professionalize, and grow their organization. So Facilisgroup provides that digital commerce platform into those businesses to help them grow. On the second side, Brand Addition, quite a different business, but in the same group and same sector. And Brand Addition, again, very focused in a specialist area, and it looks to provide products and related services in some of the best known brands in the world. And so Brand Addition's customers, you'll have heard of every one of them, based under contract and providing product, distribution, e-commerce websites and services in a consistent manner across the world. And so Pebble Group in a big space, the promotional marketing space, with two distinct and different businesses within there. And so I'll work from the bottom to the top here in terms of the highlights for 2021. I think it was a very good year. In looking at Brand Addition, 41% revenue growth. And that sort of not only is a bounce back from the difficulties that COVID caused in terms of demand in 2020, but actually that 41% growth means that Brand Addition has made a full and complete recovery over 2019 levels, which we think is a great performance. Supply chain is a big question in the world right now. In the last 3 months, Brand Addition has been dealing with supply chain. It's been the last sort of 12 to 18 months, but a mixture of a very good and experienced team, long-term supplier and customer relationships mean that supply chain has been extremely well managed. A little bit of gross margin hit this year, but not an awful lot. And so a great performance for Brand Addition. Over 2019 levels and a really well-managed supply chain in difficult circumstances. Taking us up to Facilis, a different business selling tech. You can see, I think there's 3 really great stats there. It's based in US dollars, Facilis, so that's its kind of own currency. 40% growth, I think, is outstanding. But not only the actual growth, but looking at the EBITDA margins that are coming out there at 60%. I think that combination is a really powerful platform that we've been produced there. And then underneath there, partner or our customers, the retention of those is extremely high at 98%. So if we can keep building our market share on a very stable customer base and bringing those kind of growth rates and EBITDA returns, you can see what a powerful business Facilis actually is. And so those two take us to the group highlights. 40% growth is excellent, and 2 really cash generative businesses as well. And what we've navigated over the last 2 years has been quite difficult. We're actually sort of based in London today because it's been so lovely to do sort of meetings with institutions face to face. The first time we've done that since we floated in 2019. But what we've managed to do throughout since our flotation is manage our own cash. We've kind of gone through COVID. We've gone through heavy investment into Facilis and investment back into Brand Addition, into working capital to support its growth, and all those under our own cash. And so 40% revenue growth, managing our own cash really well. I think a super performance from the Pebble Group and his team in 2021. And so what I'll do now, hand over to Claire, and she'll talk you through the group numbers.
Thank you. So this slide is sharing our key metric, and the headline here is that they're all really moving in the right direction. So Chris has talked about revenue growth, You can see that here, that's translated into growth in EBITDA, and again, that real strong performance on cash. You can see it's 5 million on where we were this time last year. This is an interesting slide, and it helps you understand the financial dynamics of the business. So the chart on the left-hand side is showing the split of revenue between Brand Addition and Facilis, and we can see where Brand Addition is that products business, and that's the larger proportion of the group's revenue. But when we've got those really super EBITDA returns in Facilisgroup, where on the SaaS subscriptions that we're charging, then that Facilisgroup is really catching up and is roughly about 50% of the group's EBITDA. The group P&L, it's here for the record. There are 3 lines highlighted in bold here, so revenue, adjusted EBITDA, and operating profit. And you can see that they've all moved forward across the period from FY19, and showing a really strong performance, and also demonstrating that what Chris just said again about our commitment into the product development in Facilisgroup and the investment that we've made. And you can see that coming through in an increased depreciation and amortization charge over that period. Cash flow, it's really strong performance, and really straightforward. There are 2 points of interest on here. You can see that movement in working capital, so there's some investment in working capital in 21, and that's all in support of Brand Addition's growth. So there's been a proportionate level of investment that reflects the incremental volume that we've seen in Brand Addition this year, and then that investment in capital expenditure, which is, as I've just said, the investment into the products that we're developing at Facilisgroup as we drive towards our strategic ambitions. And again, balance sheet, again, nice and straightforward. So we can see the working capital on there, and that is all associated with Brand Addition. So we've had some increase in volume, and that translates into incremental receivables and payables, but that's with some of the largest brands in the world. So a real quality blue chip asset base. And I say every time that if we have high quality debtors, if you invoice correctly, then we collect out on that cash. We've got stock that's well managed and underwritten by our customers. So it's a really strong, really nice, clean balance sheet that the business has got. Going to move now into a little bit more detail on each of the businesses. And if we just pause on Facilisgroup, so we are focused in North America at the moment. So that's that $25 billion industry. It's highly fragmented, and Facilisgroup is providing a digital commerce platform to the 20,000 businesses in that industry that are looking to professionalize and grow. This is the P&L for Facilisgroup. So you can see across the 3 years that we're sharing there, that period of uninterrupted growth. And I'm really focusing on the box at the bottom and the stats, some really strong performance and some amazing statistics that come out of this business. So we've had 40% growth in ARR over 20, amazing EBITDA return at 60%. And with a significant level of investment into our technology products and our strategy, we're still generating operating profit returns of over 40.
Thanks, Claire. And so now we'll kind of go, if the result from 2021, what goes behind there and what drives that is what we want to talk about now. Again, for the record, that's our revenues in sterling, but really this business is a US dollar business, so we kind of put that on there. Since we acquired the business at the end of 2018, there's an annual growth rate of 25%. And our ambitions is to actually kind of take that forward even further. But you can see, if we didn't know about COVID, we didn't know about some of the challenges that have been out there, there is a consistent growth in the business and, over the long term. So if we look at these 3 charts, if these are moving in the right direction, we know that Facilis' recurring revenues are moving in the right direction. And now the fees that we charge, the subscriptions that we charge, and the fees that sort of come to us from our preferred suppliers are all driven behind these metrics. So partner numbers going forward, the gross merchandise value going forward, and that is what's the sales coming through our platform by our customers or our partners. So if you say 200 customers and $1 billion of revenue going through the gross merchandise value, that gives you what the average size of our customers are at the moment, which is around about $5 million revenue businesses. And encouragement from ourselves to push the products of our preferred suppliers through to our partners. If that number goes up as well, that's really good for our partners, it's good for our suppliers, and it's good for us too. So those 3 metrics moving forward, I know, means that the recurring revenues of Facilis are moving forward too. And so if I kind of say we've got a great business that we built and some super metrics, now this business becomes really special if we can scale it. And the chart that's in front of you there really is how we believe we can grow and expand the Facilisgroup platform to really escalate its revenues. Right now, Facilis is a $17 million business, and that's in that top left-hand side that we're providing right now, that order workflow to those businesses between around $2 and $20 million of sales. We think there's around about 2,000 in that pipeline for us. We've got 200 partners. So the top left-hand side of this chart, that's the business that the results have been placed on today. But we'd like to grow the services that we offer to those businesses and actually extend the addressable market for us into the wider promotional products industry in North America. And so on the right-hand side, we have Syncore Light that we're making those capital investments into. That opens up a lot more businesses in this very fragmented market, those under $2 million. And Syncore Light is in heavy development stage right now, and we'll be looking to launch that mid-2023. And then below there, Commercio is an e-commerce platform. A lot of our partners right now use e-commerce. A lot of the North American promotional products use e-commerce to sell. There is a wide variety of platforms that are used, and we don't think there's any that really hit the nail on the head for our customers right now. And they've been asking us for an e-commerce solution that links into Syncore that really helps them sell to their customers. We bought some software in 21, which we further developed, and we're actually sort of doing some great beta testing. We'll be in around 2 beta testing very shortly and begin to start charging for that product with our partners. But over the next 12 months, we're looking to bring new releases of Commercio out that we believe each release will open up more potential partners to come and use us. And so what this chart is saying is, top left-hand side is a wonderful business that will continue to keep growing. We will expand our offering to those customers by adding the e-commerce platform. And then on the right-hand side, we'll increase our addressable market in North America by bringing Syncore Light together. And together, we believe that the digital commerce revenues available from this market are around about $700 million. So there's a big market for us to go for, and we set ourselves some targets that we've been tracking against. Initial aspirations to get to that 50 million mark by doing Syncore Light, those e-commerce platforms as well. That really extends the offering that we have and the market we're going to, and we're tracking really sensibly against the milestones so far. Had a very good start to 2022, which means our GMV and our spend with preferred are already towards our end goal numbers for 2022. But if we can kind of get those, the GMV, the customer numbers, and the preferred spend moving forward, we're really excited about scaling this business. And scaling this business, makes it a very, very powerful and valuable organization. Just summarising, I think we've got a wonderful opportunity in Facilis. We're really focused and have a great team that's focused on sort of those internal milestones for 2024. And that's kind of going to a successful launch of Commercio and setting great foundations for Syncore Light in 2023. And, really excited about what that business can bring. And I'll hand over to Claire to talk us through Brand Addition.
So Brand Addition, that's our products business that's working under contract with some of the largest brands in the world, providing them with exciting products in a way that helps them address their own agendas around sustainability and ESG, and do that efficiently through the use of e-commerce. Like with Facilis, we're sharing the segmental detail for Brand Addition on the P&L, and the message that I'm sharing here is there's a full recovery in that revenue line over the 2019 number. So yes, Brand Addition was affected by COVID, but what we've been able to demonstrate in 21 is that we made a full recovery, managed our margins, managed our costs, and that incremental volume translated through to an increase in EBITDA. This slide is sharing a little bit more detail on how we managed to deliver that V-shaped recovery, and it was really around 3 things. Retain our customers. So, our customers are working under contract with us, they're all still with us. We managed to win market share through converting new business through that period that we invoiced in 2021, and then we were able to grow our share of the wallet of our existing clients, and you can see that particularly in the consumer promotions line where we grew that successfully. And that was 46 million out of the Brand Addition revenues this year. And so looking at 22, saying, we've had a sensible start to the year, so we're up 11% year on year. In the middle of March, we've got 40% of our year-end expectation booked for Brand Addition. We've got new business opportunities that we converted in 21 that we will start to invoice in FY22, and then we've also got room to grow in those underlying clients. This slide is just sharing with you the diversity of the Brand Addition revenue by both the sector and by geography. And again, we've got that good geographical spread and good diversification by sector.
Okay, thanks, Glenn. I'll kind of take us home on Brand Addition and then sort of finish off with some ESG bits as well. Supply chain's been a big issue, again, kind of probably say last 3 to 6 months, but I think actually something that as Brand Addition we've been dealing with over the last 12 to 18. And when you're faced with any challenge, I think there's two things to be thinking about: the environment that we're operating in, and secondly, the actions that you're taking. And so the environment we're operating in, it's not the same products we're buying from the same factory and selling to the same customer. So we do have flexibility in terms of where we're buying from and the price that we're selling at and the products that we're actually using as well. So don't think we're trying to hit a $9.99 retail price for the same products that we're trying to do last year, bought for the same factory. We don't have that constraint at kind of either end of our supply chain. And then secondly, it's sort of, the actions that you're taking, and it's the people that are doing this. So our supply chain has been extremely well managed by our teams. And that doesn't mean it's been easy. That doesn't mean there hasn't been a lot of challenges. There has. The team have worked enormously hard. And I think it's been a great team effort. So our account managers working with our clients to make sure our lead times are working. Our teams are on the ground and actually in Europe kind of working with our suppliers to make sure product is available. If it's not that product, it's another one, and how can we work? And I think our finance teams working around Brexit, our distribution teams working around Brexit, a real team effort. And kind of, if the wind's blowing in your face, you don't kind of necessarily have to take a step back. You can stand up and take action to change it. And I think, the words, we've thought hard about, but we believe it's a well-controlled supply chain in very difficult circumstances from Brand Addition in 2021. And I'd say that theme continues again in 2022. So there's some kind of more detail on there about how we've been affected and what we've done. But I think the message from us into the market is a well-controlled supply chain and something we're dealing with under difficult circumstances, but we are dealing with it. And then that takes us to sort of the final message on Brand Addition. And the top two of these will be a familiar theme in terms of how we're looking at Brand Addition. It's retention of really good accounts, working with really sort of global brands over the long term, and implementing the new business that we win. Going away, so that win, grow, retain, repeat mantra is very sort of what we talk about at Brand Addition. And so going out and on top of that, good customer base that spends the regular amount of cash with us that then kind of builds with us over time. Adding to that is how Brand Addition grows. And the specific, I think, over the next or the last 18 months and the next sort of 6 to 12 months is very much making sure we continue to do what we have been doing and manage that supply chain, and setting ourselves again sort of that goal of moving towards, moving our margins forward in the next 12 or 18 months, not moving them backwards. And behind the two businesses, there's some commonality in terms of our cultures, our ESG, and our approach and to business generally. So ESG is something we've put a lot into over the last 2 years, but it's not difficult for us to do that because it's something we really believe in. I honestly think ESG is about running a business well for its employees, its stakeholders, it being investors, being its suppliers, and being its clients. And what's not to like about that? And so it's an easy thing for us to embrace. We've made some great senior appointments who kind of driving this on a day-to-day basis. But it's very important to me that what we do is lived and breathed in the businesses. They're not tick boxes. They're not something to kind of say we do. That whatever we say, the claims that we make has evidence behind it, and it's lived and breathed in the businesses. And that's coming through in the actions that we've taken. And what we also have is, again, a published ESG report in 2021 in October. We'll do that now on an annual basis. We've set our targets. We're going to measure ourselves against that. And I want us to do it because it makes our business better and it's the right thing to do. And so I hope it comes naturally, because why wouldn't it? It's a good way to run your business. And so just finally to sum up, I work from the right to the left again. I believe 2021 was a great year for the business, and well done to kind of everybody in our group. A huge effort that kind of went into those results. Kind of phrase of mine is results don't happen by accident, and they certainly didn't. It's kind of on the back of good people who had a good strategy, working really hard. Brand Addition started well, and order intake compared to the same point last year is 11% up. That's against the guidance that's out there around 8%. So that this time of the year, that feels like a nice balance. Say it again, supply chain feels well controlled by a great group of people. Facilities partner numbers continue to grow. We're looking to expand that with the new products, but also our GMV, so in other words, the sales that our partners are putting through the system is perhaps a little bit higher than we even thought ourselves, at 57% ahead. I think that's against perhaps a soft comparison in Q1 last year, but still, that's a really good performance, and we'll see how that works for the rest of the year. And then to sum up, what's the start for Pebble Group? I think it started well, definitely in line with expectations, and we're full of great enthusiasm. I think we've got a really good plan, and it's about us executing that. And I think our business continues to move forward, from a strategic and financial sense as well. So I hope that was a nice trot through. How do we do? 23 minutes.
Yeah.
I have to cut 3 minutes off next time. But I hope that's, there's a lot of detail in there. We're really happy to answer questions now, but we really appreciate your time today.
And we've got a question here. What gives you the confidence in achieving your targets for partner numbers at Facilisgroup?
So I think we've done really well with GMV, and if we have, if the targets are around GMV, spend with preferred, and partner numbers, so the GMV and the spend with preferred is going very well, and we think that's in a really great place. In terms of the partner numbers, we've so far had that one component of our platform has been Syncore, concentrating on those sort of businesses between 2 and 20 million. Well, we're actually extending, dramatically our addressable market by having a Syncore Lite. So the hockey stick in those numbers aren't like for like wins. They are saying Syncore Lite goes into a much bigger addressable market. So if we want 500 of those customers, there's 20,000 out there. So to put it in that context, I think is how that means to be looked at. It shouldn't be looked at. We've grown by 25 each year. We're dramatically expanding our addressable market, and I think that's why we believe those customer numbers can be achieved.
Tremendous, thank you. And going on from there, do you think that your target market of sub $2 million partners will have the same resilience in tough markets that your current partners have shown through the pandemic? Is there a chance of greater client attrition?
I think the answer to that is it's hard to get less client attrition when right now it's 98%. So, our sort of retention almost can't be any higher. And so the default answer is probably yes, that they might be a little more transigent, but also there's a lot more of them. And I really think that we shouldn't underestimate the sort of the businesses that those people have. They're a lifestyle business, so they're doing $1 million a year for promotional merchandise. Their overheads were pretty much nothing. They'll be working from home most likely, and their overheads are paying themselves their own salaries. So these businesses can, they've got no costs to cut, basically. They can kind of, if their sales slow right down, they can actually kind of, there's nothing, they're not in premises, they're not employing many people. So I think those businesses can kind of open, sort of retract and kind of grow quite quickly. And I think that's proven now, where we've been through COVID, those people, those businesses will be coming back again. They haven't sort of disappeared and gone and done something else.
Tremendous, thank you. And the questioner says, thanks for a very interesting presentation. How are the margins this year for Facilis? Previously, you said that you may trend towards 50% from the current 60%. Is that still the case, or will it happen more with Syncore Lite?
Yeah, I think we're definitely flagging, we're looking to scale the business, right? And so 60% margins are probably a little higher than we expected this year because we had an excellent sort of last quarter. And so if you think, 55% is the number we've probably averaged out at over the last 2 or 3 years, which is an amazing number in itself. And what we're trying to say is, let's put the percentage to one side for a moment. We're trying to say we'd like to spend $3 or $4 million on ramping up and scaling Facilis and spending on a sales and marketing piece. And we think that the return on that $3 or $4 million can be absolutely amazing. So if we can get to that $50 million recurring revenue, then kind of who knows where the return on sales can go, the EBITDA margin. So really think about, I think we are using money in really well to scale Facilis, and that might mean, I think we've got guidance out there, it's 50%, isn't it, into this year, and so that money has been invested for growth. It's not a permanent movement in margin, and I think that's a really important piece, because if we do get Facilis running in the way that we believe we can, and it's not $50 million is no end point, we'd like to take it much beyond there, then I think it'd be so wrong of us not to sort of make very small dints, and 50% margins is a pretty amazing number anyway. So if we can spend a little bit of money in scaling Facilis, I think that is money tremendously well spent right now.
Thank you very much. And the questioner goes on to ask if you can talk a little bit about broker forecasts. It's not easy to get access to Berenberg research. It looks like earnings per share estimate is for 4.61p for 22, which is down from 21's 5.14. Do you know if the 4.61p is right, and why is the earnings per share number coming down?
Yeah, so the 4.61 isn't a straight comparative to the 5.14. So the right comparative would be 5.15. So what we're saying is we think it's going to be flat next year, and that's really around the investment that we're making into Facilis Group. And so we've spent £5 million over the last 2 years on those two products. We're forecasting to spend another 8 million this year, and we're amortizing that over a really sensible period of 3 years. So we will see an increase in the amortization charge that is affecting that forecast number. But our expectation through the broker is that that's going to be flat.
Tremendous. Thank you very much. And what's the split on people numbers between Facilis Group and Brand Addition and the group?
Yeah, okay, so we've got just over 500 people in the group. About 100 of those are in Facilis, and 50% of those are in tech development there. So we've got 8 at the Pebble Group, and then the balance is in Brand Addition.
What plans do you have for using the cash you're generating as the planned growth comes through?
The Pebble Group is very cash generative through Facilis and Brand Addition, and that's been proven in the short time we've been on the market. We're definitely investing for growth right now. If we're successful in executing upon those strategies, then cash does come into the business very strongly. I suppose we're looking forward to that position being a reality rather than a kind of a thought. So there's no firm plans for that right now. I think our heads are sort of focused on getting our strategy right, executing well upon it, and we really look forward to managing that kind of challenge when it comes. But I think we're in a good place, very cash generative model, and let's hope we are able to execute on the plans and have that really great issue for us in a couple of years' time.
Thank you. And can you please talk through the contract terms for Facilis customers in Syncor and Commercio? So length of contract and element of volume versus recurring revenue.
The contract length is 3 months. The notice period, that's all it is. And we want people to be using our digital platform because it brings them great services, and we're not looking to tie them in over many years to something they wouldn't like. So people use Facilis because they want to be part of a great organisation that kind of has great technology, super supplier relationships, and great community. So those contracts aren't long in length. In terms of the recurring revenues are 95% of the revenues in the business, and those recurring revenues split around about 65% comes from subscriptions, and 35% comes from sort of marketing funds.
And that's the end of questions. Chris, do you have any closing remarks?
I think always really important when I get an opportunity to say something publicly. Results don't get achieved by accident. There's an amazing group of people. There's 500. It's kind of crazy that there's 500 of us now. But thank you to the team for again continuing pretty unusual circumstances. It couldn't be done without a great team effort. So thanks to everybody. And we're always interested in understanding questions, communicating our messages correctly, and so any feedback, we'd be really thrilled to receive it and grab questions from anyone again. So thank you all for your time.